Thanks very much for that. Sanjay Parekh is now with us. He's founder and chief investment officer at Sohum Asset Managers. Sanjay, good afternoon. Great to have you with us here as always. And, interesting time to be speaking with you because, as of today, as of now, the small cap index is down about 10% from the highs, from the recent highs. So, talking to you, someone who's a stock picker, I just wanted to ask whether anything has caught your eye which you wanted to buy and which is kind of corrected. Many have come off 15, 20, 25%. So it's an open-ended question. So do answer that. And I wanted your specific thoughts on Angel one. That caught my eye. That's lost about 25% of its value from the highs. I'm not sure if there is some other fear because, you're hearing warnings from the regulator in terms of the froth, etc. Could it be possible that on things like, the margin trading facility, which brokers offer, which has been highly profitable, the book has grown quite a bit. Could there be some restrictions? I mean, I'm just sort of thinking out loud here. Just your thoughts on that one. But first start with what you noticed. Go on.
Yeah, Prashant, good afternoon. So basically, ours is a large cap fund dominated by large cap. And we have middle and small cap, but we buy them if we feel the divergence is high. As of now, we are 84% into large cap. We moved from 77% to 84%. And that is because we were seeing froth in mid and small caps. So we really did not find a lot of value in the last 2-3 months. And of course, we use a bottom-up approach. If it falls within our filter, we would look positively. But we believe still, there's a lot of froth. If you take the Bloomberg consensus estimates for mid-cap, it's 26 times 1 year forward. Small cap index is not representative because, the stocks you don't like are really cheap, but the rest of them are at 25 to 30 times, somewhere 35, 40 times. And we all know that flows, the flows doing its wonders on valuations, be it AIF, PMS or mutual funds. So I think there is still a lot of froth. One has to be very selective. This could be, it doesn't end. In small and mid caps, reactions don't end so soon. So I think one has to be careful. And one has to be really on a stock basis. If there is, of course, something that you like, you have to buy them. But I think we are still far off from those levels where we would want to buy in mid and small caps. On Angel, of course, we used to own it, and now we have sold it because we didn't find it very cheap at 35, 3600. I think it's a great franchise now, reacted quite well at around 20,000 crore market cap. It's going to raise 2,000 crore. Mainly, they've stated that is because they would have to, the whole margin funding route, wherein earlier, clients' money could have been used is now not possible, and hence they would need some working capital. And that's where they've not stated any potential acquisitions that they want to do. But that is what the stated, policy from their side. So now, of course, market view is very important because very large part of their profits pool is from derivatives. So, and then, of course, if there is any regulatory change there, we'll have to watch closely because there has been earlier indications by SEBI saying that, almost 95, 97% people don't make money. And, all that stuff. So we have to be watchful, but I don't think, there could be any major clampdown there. It's a great franchise with profits which could be around 1150 crores this year, 1,300 crores next year, and then it could even further increase, 13 to 1,400 crores. Of course, it depends on markets. So it's pretty reasonable now. And, we certainly will watch it again to look to add. But, having said that, broadly, we don't see any regulatory change coming into Angel from a SEBI perspective on the derivatives, which is a large profit pool for them.
Okay, all right. Hi, Sanjay. Good afternoon, Nigel on this side. I recall our last conversation. You said it makes sense to go overweight on HDFC Bank. Till then, till a month or so ago, you were actually underweight on HDFC Bank. you all had higher exposure to other banks, SBI Bank, a couple of other banking names as well. Have you all gone full throttle on HDFC Bank now in the last 1 month or so? And do you still maintain that? And since earlier you all were overweight on SBI in comparison to HDFC Bank, at current reckoning, what is the choice?
Yeah, so SBI still is a very large overweight. We are around 7%. Till last December, for almost 9 months, it did not, give us results. But you saw we're just seeing the first year to date, index was up 3% and SBI has done some 20%. So that's what it is. It's always non-linear. It was very, very attractive. It still is attractive. And we would want to hold on to our exposure in SBI. Because today also at current levels, I think it's 1.1 times FY26 and 1.35 times 25, which is very reasonable for ROEs of 18 to 20% and ROA of 1%. HDFC Bank, we marginally increased our weight, and in our PMS, we have further increased. We genuinely believe, that a lot of negatives which are in the near term are, they're all in the price. We will see some more some more consolidation in terms of, because the whole merger was pretty large. So the whole liability side, slowly, the growth has to be there, and asset side growth will be reduced and NIMs would go up. But they have a very strong cost lever, and I very confidently feel that, if the earnings growth expectations are reasonable, they will be met. So I think it's very, very attractive on valuation. It could take 1 quarter or so, but from a price perspective, I think it is very little risk in HDFC Bank.
Okay, that is HDFC Bank. Overall, what's the sense, considering that we're in this phase where everyone's, first of all, second guessing when the next round of rate cuts happen. Then we're running into an election season as well. And then you have all the regulatory scrutiny. So what is the strategy? Just the near term, given the elevated levels the market is at, how are you looking at things?
Yeah, so, earlier also we had said that this year we're going to have mediocre returns and that will be back-ended. We are certainly, even on Nifty, we are not cheap, So, and as I said, the froth in mid and small cap is higher. But in Nifty also, if you take earnings of 1100 on and we give, India, I don't think we should go beyond 20 times for our interest rates. So, then you go to 22,000, that's where we are. And you have a whole 6 to 9 months ahead for 25. And then we look at 25, 26, and maybe, there broadly, we don't have visibility, but 1250 is a possible scenario, which is nominal GDP plus growth rate. So, we are moving faster, which is 3 to 6 months ahead, and maybe 3 to 5% on price. And both can happen. And we have events now, politics is one where we know there's going to be continuity, but then we would have monsoons, geopolitical risk, even certain issues around water, we can't ignore. It's still small, but we need to watch how the administration is handling it. It's not in one area if it gets broad-based. So we have to watch all this. And that's why we believe that valuations are not cheap, and we would have back-ended returns this year, and that would be mediocre. That's our view, even in large cap. So mid and small cap for sure, we think that they can react further.
So since there is still a lot of froth in the mid and the small cap, would you look to up your large cap exposure? You've already increased it from 77% to 84%. Are you looking to raise it further by paring down your holding in mid and small caps? And as you did that in the last couple of months, what were the stocks or the sectors where you sold off some of your positions?
Yeah, so Reema, you'll always feel that your mid and small cap will not fall, right? And you always have a bias. But what we've done is, when we got money, the incremental money, dramatically, almost 100% was going into large caps. That too selectively. I don't think cash will hurt from this levels. If you have even a cash levels which we keep in the range of 0 to 10, I don't think it's going to hurt you. So, but we look for stocks at our comfort zone, and we've almost not added much in mid and small cap. In fact, we sold off, reduced broadly. As I told you, angel broking was one. earlier Jupiter Wagon, before that Sirma, and even we have trimmed in some of the exposure we have right now. So we have done that, and we will watch now for a better entry price in mid and small cap for sure. And in larger cap also, we are very selective given our stand on the markets that we have.
You know, while we started with Angel one, but look at the other one, BSE, the exchange, sharp recovery, almost a 4% recovery is what we are seeing on BSE. The intraday will tell you what's going on. Look at that. It's down just about 2.5%. It was down 6% when we started. So that's a pretty sharp reversal coming in on a large liquid name, which is, of course, done exceptionally well. And on Angel, as Sanjay was pointing out, they do 1,400 crores. You're talking about the stock now trading at some 14 times earnings after the 25% fall. But there is that QIP or that fundraise, 2,000 crores, as you said, perhaps a bit of a overhang at this stage. The other one, Sanjay, you own is ABFRL, right?
Yeah.
And so it's like you're taking the opposite trade. Trend has done very well, ABFR has done very poorly.
No, I mean, I'll be very admit, it's perhaps, it's not done well for us. And it's just that sometimes you don't want to sell at any price. And here, these are the stocks that keeps us grounded because it's really one of the worst performers we hold. And, they have, of course, expanded and that whole thing that the acquisition that they've done is taking time.
But will it I mean, because you must do a constant evaluation, is the thesis with which you bought not turning out to be the way you thought, or it's just taking longer?
It is taking longer, and it's not that we don't, I mean, we genuinely believe it could be taking a little more time. They have size, critical mass, but the profitability is getting affected, and then you slow down as well. So certainly it's, otherwise we would sell it. I mean, we are fine to admit that we went wrong and we sell off. But this is one where we want to hold on for a while. We will be patient with them, and we'll see for another 6 to 9 months, where they get back to the profitability zone, better profitability zone, and then, the whole acquisitions they have done, organic, inorganic, all of it, whether they can consolidate well across the formats they have bought into. And that is where the street has less confidence. It's very, very reasonable now. I mean, it's almost like a commodity valuation if you look at even EV, EBITDA after rent. So it is reasonable. So that's where we want to hold on for a while, but it's certainly underperformed compared to Trent or any other retail like Titan. It's significantly underperformed.
Okay, all right, Sanjay, you need to admit sometimes when you're doing that, go right sometimes, but make sure, your rights outweigh the wrongs. Thanks a lot for joining in, and thanks so much for giving us your take on a whole host of stocks that we discussed as well.